Hi, everybody. Welcome back for another episode of the Entrepreneur Aligned podcast. I'm your host, Jarrod Musick. Thanks for joining me today for a conversation about how we map business cash flows over to personal financial outcomes and the needs of our business owner families. So it's usually one of the largest challenges. If you think about what financial planning is for the 91% of the population that is part of a household that doesn't own a business or is not self-employed, you're really looking at, okay, what's my wage earning path, right? I'm looking at W-2 wages, maybe I'm looking at project fees, something else that you're doing where you generate more predictable income, but it also narrows the range of potential outcomes, right? I might get a 10, 15, 20% bump in pay. I might get a new bonus pool. I might get some stock grants or awards. But for most people, it's base, bonus, benefits. That's what you're looking at. That's what controls sort of your destiny on the personal financial planning front. Now, as you know, if you're listening to this podcast, if you're a business owner, you can literally go from negative to plus seven figures every other year, right? That's what your cash flow path can look like. And we're not even talking about the equity appreciation inside the business because, as we know, as an entrepreneur, you make money in two ways. One is the cash flow that you generate and are able to take out of the business as it's going. And then the second is the equity value, which you can unlock through a variety of different things: external sales, internal sales, lots of other paths to be able to unlock that equity long term. So when we're talking about the challenge of financial planning for ourselves as business owners, it's a big one, because how do we actually create sort of this more predictable model? How do we build those guardrails in a place where it even makes sense? Because if you put in a cash flow parameter of I'm going to lose $500,000 to I'm going to make $5 million this year, think about a highway with 72 lanes, right? It's so massive. It's like, yeah, I'm generally going in one direction, but I can turn 90 degrees and I don't hit a guardrail for a long time. So when we're thinking about how we actually do this, we always want to plan for a range of outcomes that are reasonable. The more mature the business, the easier it is to understand what reasonable looks like. If you have a 7% growth rate on your company, maybe what you want to plan for is, negative 10% as an outlier year to, possibly plus 20% as a really outlier, outstanding year. And then you can modify those year to year to year and look at what does that do to our cash flow projections. Particularly, we want to examine this when we're looking at taking on debt, pursuing business expansion, acquiring a competitor, doing some of those other things, and really looking at that through the personal financial lens as well that says, okay, here's the cash flow that my family needs for our baseline living expenses. Here's the cash flow that we need to have the lifestyle that we really want: travel, replacement of vehicles, paying for education for kids, clothes, activities, all of that kind of stuff, right? The extras beyond usually covering a mortgage, food budget, utilities, and the basics, right? So that's the lifestyle that we want. How much do we need our business to generate to produce that lifestyle? And then you're looking at, okay, if we get to some of those outlier years, what do we do with that excess cash flow? Do we save it? Do we sit it on the sidelines for business reserves? Do we allocate that back into the business to grow faster? Because we know that the number one way to create and build wealth is to continue to grow this business that can grow at pretty high rates that we have direct control over, right? Is that what you want to do? Do you want to do some mix of all of those? I can tell you that if you don't have a plan when those outlier years come up, you will find a place for your money to go, and it may not be in the places that are going to help you and your family move toward the outcomes that you want. We see it over and over: taking on expensive hobbies like private aviation, starting an outside business, buying a second or a third home property, investing in real estate deals from your buddy who's putting together a syndication to do an apartment complex that is a can't miss proposition, right? You need a mechanism to be able to examine those and say, okay, is this serving us? Is this getting us where we actually want to? Because as entrepreneurs, we are drowning in nothing but great opportunities. The more success you have, the more people give you the option to participate in other ventures, other things that could really produce well or produce a big fat zero for you. So thinking about how you want to allocate that ahead of time is what we really want to do. So now back to the financial planning component and looking at the guardrails. Let's say that you have a business where you have the opportunity to go and acquire a competitor. You're currently meeting all of your baseline and lifestyle needs for you and your family. The equity value in your business is growing reasonably predictably. You're growing, 10 to 15% a year. Everything's kind of on track, but this opportunity comes up to acquire a competitor who's about your size. You have to take on debt to be able to do it. And in today's interest rate environment, as I record this in the fourth quarter of 2024, if you're looking at SBA loans or private credit loans, you're probably somewhere between 7 and 11%, depending on the business, stability of the cash flows, lender you're working with, et cetera, right? But it's no small thing. So you're saying, I'm already meeting all of the needs that I have, but I have this opportunity to really move the business forward in a pretty substantial way. Is that where I want to put my money? Well, enter the personal financial plan, right? Because the health of the business and planning for that and how you want to assimilate that growth is one part of the process. And that's what we're really good at as business owners, is seeing what's the risk profile and what could I get out of this. But looking at it through the family lens, okay, what's your debt coverage that you're going to be getting out of that new company? If this is really a growth initiative, if you're buying something that has, 20% profit margin on it, what does that profit margin truly look like after you acquire the business? In a lot of these, hopefully you're able to gain some efficiencies in terms of management, operations, marketing, other things like that. And maybe you can expand that margin and it goes to, 25 to 30%. That's a fantastic outcome. But maybe you look at it and you go, oh boy, this company is a little bit of a mess. That's why they actually want to sell. Once you get under the hood during the due diligence period, sometimes you find out things that you would have never known from the outside, right? A company can look amazing from the outside and be terrible on the inside, or vice versa. It may look really rough, and once you get inside, you're like, man, this thing runs really, really well. So once you get in there in the diligence period, you may look at it and go, oh boy, we're going to need to push some of that cash flow back in to fix some of these issues. So now it's only a 12% margin business. Is that something I want to buy? How much is my debt cost going to be on the cash flow? And you can look at that in those scenarios and go, okay, well, I think this is actually going to add to my net cash flows as a family. I'm comfortable with the debt structure. We're going to get a better outcome for the business as a result of doing this. I'm comfortable taking on the debt, buying this thing, rolling it in, and we're not going to have to change lifestyle. And our big goals, like paying for Judy to go to Duke 2 years from now and being able to buy our house in Big Sur, California, which is our favorite vacation place in the world, right? All of that stuff is still on track, even if we do the acquisition. Great. That's a great way to look at it. And looking at the guardrails and saying, well, what if we have a hiccup? What if there's a recession? What if? And working those through and really looking at, okay, does it still work? Even if we have some of those blips, do I have enough cash on the sidelines to be able to weather the storm without having to change substantially business plans or plans for my family? Now we're looking at the other side maybe and say, okay, we need to recycle some of that current profit back in to get this business back where it needs to be. We think that's going to need to be the case for the next 2 years. We're net negative on debt coverage when we look at cash flow from business operations. So let's say that there's $200,000 a year that is going to have to come from current cash flow or reserves to be able to bridge that gap for a 2-year period. You still think it's a great deal for the business. You still think it can really help you move forward, but it's going to take some time to get it there. Looking at that and saying, okay, are we willing to make those trade-offs as a business? Meaning maybe some of the other initiatives that you have on the table are going to have to go away if you do this. And then certainly as a family, right? So maybe you say, boy, we're not going to be able to buy that house in Big Sur for another 5 years if we do this. Does that still work? It's going to be tight when we're paying for this business and we have those Duke payments that start coming up in 2 years. Is that what we want to be doing? So really marrying those two up, the business side, the strategic business initiatives, projecting business cash flows, tightening those guardrails down and saying, okay, do we at least have a reasonable expectation for what this business can look like over the next 1, 2, 3 years? And can we make really good decisions based on that? We always say that there are 2 areas that remain true for business owners that are not true for most people. The first is that your business is almost always going to be your best returning asset that you have in your portfolio. Don't try and beat that, right? If you have something that you're able to compound and grow at 15 to 20+% a year, You look at the S&P 500, and if you can invest and stay disciplined and not have to pull the money out, and the next 40 years look like the last 40, maybe you're earning returns that are in that 10-11% range, right? That still pales in comparison to getting a 15 to 20+% compounding return out of your business. It's absolutely fantastic. So make sure that you're able to continue growing that business. Make sure that that's where you're putting your risk capital by and large, and starting to build some other things, right? And that's part of what we do when we're building investment policy documents, is looking at how many eggs do you want in the basket of the business? How do you want to start building some that are outside the business? But where we see entrepreneurs get themselves into trouble is expecting their outside investments to perform like or better than their business returns, right? It just typically isn't going to happen unless you luck out and you get in the perfect real estate syndication deal with somebody who really knows what they're doing, and you're going to get that return. But even so, that's not going to be your portfolio return across all assets. So we always want to make sure that there are plenty of things that are going to perform differently and move differently than your business. Cash on the sidelines, sitting in premium money market accounts, sitting in true cash, sitting in different types of portfolios that are intended to be lower volatility. So you're going to be earning those mid to low single digit returns on those really conservative pieces. Yeah, you probably want some public market equities that are in there that, depending on your allocation, call it, those are going to be high single digit returns over time, maybe low double digit returns. And then as you really have a lot of excess and you're starting to, pull significant amounts of capital out of the business, or you have a business exit, now we're starting to go into those other things, private credit, private equity, some more, off of Main Street type strategies that are going to offer you a different return profile. But that's usually the last piece that we're stacking in. So really thinking about, if my business is going to be the best returning asset that I have, I need to focus there. So that's one of the two things that I alluded to a minute ago. The second one is you're going to need to hold more cash as an entrepreneur than most non-entrepreneurs, because your range of outcomes do differ significantly. If you're going to have a period where you think the business could potentially lose $500,000, well, you need to have those reserves probably in the business, probably personally, probably both, right? And thinking about how long that type of situation could occur, how long do you need to bridge that gap? That should dictate how much cash and reserve capital you have. Lines of credit can help, other things like that as well. But really thinking about what backs up that great returning business that you have for the long term. So the two elements there, as you're thinking about it, your business is going to be your best return most of the time, and you're going to need cash to back up that business to get that return. So hopefully this was helpful, thinking about the process of marrying up personal financial planning, business planning, and how those two come together to make sure that you and your family get what you want over the years as the business continues to grow, and that you're able to make really good business decisions and set those guardrails appropriately. Thanks for giving me some of your valuable time. I appreciate it, and I'll be back with you again soon.